What's going on, my fellow wealth creators? Matty Ice here. I wanted to do a breakdown of an awesome video I just watched. It's an interview with Grant Cardone and Brian Rose from London Real. So many awesome lessons. But what was really interesting to me was without them actually talking about the infinite banking concept, they prove how powerful and important the infinite banking concept is and how powerful of a foundation it provides when you set up a properly structured dividend-paying whole life insurance policy. That's what I'm a huge advocate for it. Infinite banking, dividend-paying whole life insurance. It's your first time on the channel. I'm a huge fan. That's why I started the channel. And it was just really interesting because, I imagine they've heard of infinite banking. Maybe they use it, maybe they don't. But without actually mentioning it, all the problems that they were talking about can be solved with a properly structured policy. It's just incredible. That's why I love the infinite banking concept. Is it for everybody? Of course not. It really depends on your goals, your finances, your situation, what you're looking to accomplish, etc. But if you make a decent income and you're looking to build wealth and you're open-minded, you want to make sure that you're putting your money in the most efficient vehicles and assets possible. And also, if you look around and just see all of this chaos and uncertainty and not 100% sure how to deal with it all like I was, then it's definitely something that you want to explore. I'll tell you, I sleep so much better at night with the policies that I've set up because they solve so many problems with one financial vehicle. It's just incredible. So I want to go through the video because there's some really interesting things they bring up. And I want to talk about how it correlates to infinite banking and how a properly structured policy can solve the problems that they're bringing up. So let's dive into it. All right, guys, let's get into it. I skipped ahead just a little bit just to get through the intro. But yeah, let's learn some good stuff here.
Or Charles Schwab. Charles Schwab's probably, $2 or $3 trillion under management. What he did was he just made it very easy for people to invest. Say, send the money, we'll put it in a whatever ETF, which is basically just a garbage dump of stocks. And if people really understood the truth, like Warren Buffett's never invested in an ETF, okay? Not Bogle, the guy that created Vanguard. He never invested. He would never, ever invest in that, but he created a paper product.
All right. Let's talk about that for a second. I think there's an important lesson in there, and that is to, if we want to build wealth, we should probably mimic what the wealthy do, or at least pay attention to it. Like, success leaves clues. And what's interesting is a lot of the things that we're taught to do and often end up doing is the complete opposite of what the wealthy actually do. So, he's talking about the wealthy, super wealthy, not investing in ETFs, probably don't do 401ks as well. Not that those things are bad and that they don't have their place. I think they do. But my point is that a lot of the things that we're taught to do are not always in our best interest for reaching our goals. Think about it. Like, what are we often taught throughout our lives? Is that's to go to college, get into a ton of debt in order to do it, and then get a job, buy the house, start the family, etc. Go into all this debt and stuff as much money as you can into your 401k, and hopefully, the market will do what it needs to do in order to provide your nest egg. That's pretty much what we're told to do. But do you really think that the people who are ultra wealthy, or not even ultra wealthy, just have accumulated and built up a significant amount of wealth? Do you think that's really what they're doing? Probably not. So how this relates to the infinite banking concept is like there's a lot of pushback a lot of the times from people like Dave Ramsey and Susie Orman who just have no clue what they're talking about when it comes to infinite banking, dividend-paying whole life insurance. There's a lot of pushback that it's a terrible place to put your money. And then traditional whole life policies where it's not custom designed for cash value, it doesn't utilize paid up additions, et cetera, like we do, like I used for my own policies, then, are they kind of bad as far as like internal rate of return and stuff? Sure. But when you custom design them, they can be extremely powerful, very, very efficient savings vehicles. And here's the thing, it's one of the reasons why the largest financial institutions in the world, i.e. banks, buy billions and billions and billions of dollars of bank-owned life insurance is the technical term for it. But it's essentially dividend-paying cash value whole life insurance. And if these banks are buying it by the tens of billions of dollars, and it's considered tier one capital on their balance sheet, maybe we should pay attention to that. If that's where or one place where the ultra wealthy is putting their money, and it's considered tier one capital. And the reason that is because these life insurance companies, these preferably mutually owned life insurance companies, are some of the strongest financial companies in the world. Usually far more safe and better at risk management than banks are. And, you know, a lot of them have never missed a dividend payment for over 100 years, some of them 150 years, right? So if you know, a lot of these banks are buying billions and billions and billions of dollars of this cash value whole life insurance, maybe that's something we should take a look at. So the point is, you know, if we want to build wealth, we need to study what the wealthy are doing. We don't need to do everything that they do, obviously. And like I said, there's a place for ETFs. There's a place for 401ks. You know, it just depends on your specific goals and situation. But we need to pay attention to what the wealthy are actually doing. And the wealthy buy a lot of cash value whole life insurance. So, you know, just something to pay attention to. Let's continue.
That people can send $50 to, or $100 to, or $200 to, and people think, oh, I'm invested in the stock market. But you can't get the money out for 30 years. And I believe 30 years from now, taxes will be double what they are today.
Okay, this is really important. This was like the first really big aha moment that I had when listening to this interview. So let's break this down. So the first thing he said that you have to wait 30 years to get access to the money. That's not always the case. You know, like 401ks, like for example, I mean, you know, you can take loans against them, but you got to pay attention. You got to make sure you know what the terms and conditions are. What happens if you change employment? Can they call that loan at any time? How much can you actually get access to? Do you have to wait for it? Like, there's all these restrictions that you actually don't have with dividend-paying whole life insurance policies. You can actually take a policy loan for any reason. There's no application. You don't have to explain what you're going to use the money for. There's no approval process. It's just, here's how much I need based on how much cash value I have, and then it's in my account in 2 to 3 days. 2 to 3 business days. So you don't have to wait to get access to that money. And also when you do that, it doesn't interrupt the compounding process that you get with these policies. They typically net 3 to 5% tax-free compound growth for the life of the policy. And when you borrow against it, you get access to that money. You can use that money to build wealth. As I record this today, like I'm using my policies to build wealth in a couple different ways. And one of those ways is flipping heavy equipment. And I just got the text today that we sold one of the pieces of equipment that I purchased using my policy. So I first funded my policy, but instead of having that money tied up, or, you know, I'd have to pay penalties or taxes on it, or, you know, there's all this red tape around getting access to it. I literally just log into my online portal. I told them how much I needed, borrowed it, purchased the heavy equipment. My partner fixed it, flipped it, and we made a profit on it. And now I can put that money back into the policy. All the profit covers any interest that I paid, plus the policy continued to grow. So my point is, with these policies, you get really good liquidity to continue building wealth how you normally would anyways. The other thing you mentioned is the taxes doubling in 30 years. I'm not going to argue with that. Are they going to double, triple? Are they going to go up, 10%? Who knows? The one thing I think we can say for certain, though, is that taxes are going up. If you look at taxes historically, the tax rates are pretty low right now, historically speaking. Yet our debt is skyrocketing. There's so many issues with government in the country right now. It's just insane. I think, and actually Grant's going to mention this at the time of this recording, the government is taking on $1 trillion of debt every 100 days. How do you think that's going to be paid for? Where do you think that where the interest payments on that debt is going to come from? Not to mention the higher interest rates on that debt as well. It's just this downward debt spiral that we're in right now. So the only way out is to inflate it away and probably increase taxes. So if you're concerned about your tax liability, let's say you make a decent amount of income, you're in a higher tax bracket. I mean, do you really want to set yourself up to be paying taxes later on, or do we want to get that out of the way right now and put our money in tax-advantaged vehicles like dividend-paying whole life insurance that can significantly reduce our tax liability? The cash value grows tax-deferred, and you can get access to that money tax-free when you set it up properly through the use of policy loans. And because it's a policy loan, it's not considered income, right? So you can actually create a tax-free retirement income stream later on down the road. So we want to make sure that we're limiting our tax liability as much as possible here, especially since taxes are probably going up. Also, I want you to look up the Tax Cuts and Jobs Act I can't remember exactly what year it was passed, but it's set to expire at the beginning of 2026. If it is not extended, that right there is going to have a major impact on people's taxes. So all these things, it's creating this scenario where we're probably going to have a lot higher taxes in the future. So we want to prepare for that now. The last thing I'll say about this particular statement, the other thing that's going to double is the cost of goods and services in 30 years as well, probably sooner, because of where inflation's at. So we want to make sure we're putting, or at least I do, this is not financial advice. You can do whatever you want. I'm just trying to point out the power of the infinite making concept in dividend-paying whole life insurance to solve all of these problems that he's talking about here. Even though he didn't mention inflation, it is a big, big problem. So if you're planning on having $2 million in retirement, and you think that's going to be enough, but you have not factored in the impact of inflation on that as well, you're going to be sadly disappointed that you're going to need double that in order to just have the same standard of living that you have right now. So you have to prepare for that. Dividend paying whole life insurance is a great way to keep up with inflation because you get that net 3 to 5% tax-free compound growth. And with the tax advantages, you have to add on another at least 1 percentage point, maybe 2, depending on your tax bracket, to that internal rate of return as well, because of the taxes that you're going to avoid later on down the road. So for me, it's a great inflation hedge because of that uninterrupted tax-free compound growth, but also because I can use my cash value to build wealth. The piece of equipment we just flipped, the actual rate of return was like a little over 6.5%, but annualized, and we did it in about 10 weeks. So annualized, it was almost a 40% return. So I could keep doing that over and over and over again throughout the entire year. That's a pretty good rate of return, far more than the inflation rate. Maybe who knows what inflation actually is. But anyways, I thought that was a really, really good, powerful statement. There's a lot of lessons, a lot of things to consider in that statement. So let's continue.
So why would I want my money taxed twice when I retire? So what we did, we created that platform and say, hey, take your retirement money, put it into this real asset, not a piece of paper, this real asset that distributes cash flow now, right now, not 30 years from now.
Right. I love that statement. Putting your money in assets that delivers cash flow right now. There's a concept called accumulation theory, where what we're taught to do is to try to accumulate as much. For example, we want to contribute as much as we can to our 401k, accumulate this wealth so that we can spend it later on down the road, but it doesn't produce any cash flow right now. One of the most powerful things I learned within that lesson that the gentleman was talking about, his name's Garrett Gunderson. I would highly recommend you look him up. He's got a great YouTube channel. I learned this in his book called Killing Sacred Cows. And it was just a wealth of knowledge. But he's a big proponent of buying your net worth, building your cash flow. I think that's really, really powerful. Again, this is just me. And we're hearing this from an ultra wealthy person he's built a lot of wealth. So I think he knows what he's talking about. We don't have to agree on everything, but we want to build cash flow now. The great thing about dividend paying whole life insurance is that when you get the policy, you already have a massive net worth that you can pass on to the next generation, number one. Number two, we can use that because it's going to continue to grow. We can use that for cash flow, like our tax-free retirement income later on down the road. We have living benefits in case something happens to us, but we can use that cash value now to invest in assets that produce cash flow, like real estate and businesses. Like, I'm flipping heavy equipment. I'm going to be doing private money lending very soon on real estate. And so I have these businesses that I'm able to capitalize and fund with my policy. My policy is going to continue to grow regardless, but then I can use that to build cash flow in my life right now. And 30 years from now, you have those cash flow assets, those assets that are producing cash flow for you. You're going to be set up really, really good versus just trying to accumulate as many stocks as you can or whatever that, it's not producing any cash flow right now. So I think that's really, really powerful. Let's continue.
That you can live off of, improve the quality of your life, buy a car, rent your place, buy a home, whatever. It supports people in their payments.
Okay.
And people are responding to it.
Obviously.
You know, and the JP Morgans and the Goldmans and the Wall Street guys that, you know, they just basically ignored retail investors.
Yeah. Well, this is the problem. It's called the Innovator's Dilemma. I worked in Wall Street for 15 years, right? That's why I'm in London. I came here to do credit derivatives with all the institutions. My clients used to be Goldman Sachs, JP Morgan, and on Wall Street, I traded derivatives. So I know that whole business. And funny enough, Grant, now the last 3 years I've gone into crypto. What crypto shows you is how much the banking system rips out of the economy.
Yeah.
Oh, yeah. Yeah. It's absolutely insane. I mean, a lot of these people are just crooks, you know, Wall Street, government, and yet we give the majority of our hard-earned money to them every single day, every single month. We're dumping more money into their products that they shove down our throats and teach us, you know, it's the best way to build wealth. And then they don't even use the products that they sell to us. Like it's ridiculous. Number one, but two, I'm reading this book right now. I highly recommend it. You guys have probably heard of it. The Creature from Jekyll Island by G. Edward Griffin. All right. It basically goes through the history of the Federal Reserve, Wall Street, corporatism, crony capitalism, like all this stuff. And it's just disgusting. You know, there's just absolutely no morals in ethics whatsoever on Wall Street, at least that I've seen. And so do I want to be putting my hard-earned money, giving my hard-earned money to them and relying on what they're providing to build my nest egg? Absolutely not. Not for me. Not saying that you shouldn't do it. Again, it's not financial advice. You need to do what's best for you, what makes sense for you. And also, I'm not saying that like all Wall Street products are bad. Like, you know, he was saying earlier, ETFs and stuff, REITs, real estate investment trusts. Like there's assets that we can use. My point is, though, is to blindly give our money to Wall Street and government sponsored tax qualified plans, whatever, without really knowing how they work. And if there's a better option, like if there was a better option, a much more efficient place to put your money, would you want to know about it? And how soon would you want to know about it? Right? I mean, I would. That's why I started going down the infinite banking rabbit hole. And, you know, I don't think it's any coincidence that, you know, places like Wall Street, institutions like government don't teach us these things because it's not in their best interest. They can't extract as much wealth from us if we start to understand how these things work. And we realize that there is a much more efficient place to put our money. For me, it's absolutely dividend paying whole life insurance. So I can implement the infinite banking concept and get all of the benefits from the policy, all the problems that one policy can solve.
6 and 8% of global GDP is stolen from banking institutions. And I always tell my students, and you don't even know it, right? They take it from you and you don't even know it.
Right.
And it's all basically a racket is Wall Street.
It is a total racket.
It's a total racket. There's a lot of rackets out there.
There's some simple indications, right? When you drop off money at, let's say, a bank, first of all, you go there, they're open at 9 o'clock in the morning. They're closed at 5 o'clock. Most of the day they're closed. You can't really get anything from them, okay? You drop the money off. You can't get it on the weekends. If you're using an ATM machine at 4 o'clock in the morning, you know it's not good for you. They say they're going to pay you 1 or 2%, but the truth is they're going to charge you over 1 or 2%.
Okay, real quick. So actually, I think
just keep your money at the bank. You don't make any money.
I think there's we're going to talk about liquidity and access to the money here in a second.
It is a complete racket,
right? And they don't give you your cash when you want it back.
Yeah, if you want your cash, if you go in there so hard 72 hours later and say, "I want my 100 grand back," you cannot get that 100 grand. You're going to probably wait 3 days to get it back.
Yeah.
Boom. Okay. So let's talk about that. That's huge. And I've heard Grant talk about like on some of his other content where, you know, he's tried to get a significant amount of money in the bank and they ask him all these questions. He's got to go through an application process, get approved for it to get access to his own money. It's insane. I haven't personally experienced that yet, but I also don't keep a lot of money in the bank anymore. So you know, I don't plan on having that issue. But how this relates to the infinite banking concept is we have access to our money whenever we want, and we don't need to explain anything. We don't need to ask permission. I literally go on to my online portal. I tell them how much I need. If it's over a certain threshold, a certain dollar amount, that I have to call in and do it, but I don't have to explain anything. I tell them how much I need. It's in my account in 2 to 3 business days, depending on when I request it. So, you know, there's still, like he's saying, he mentioned that you got to wait 3 days to get it. I mean, that's just normal processing. But you know, I don't have to worry about ever having access to my money because it's my cash value, and it's collateralized by my death benefit when I request those policy loans. So having that access is just that security peace of mind knowing that I can access my money whenever I need to, however much I need to, depending on, up to a certain limit with my cash value, whatever that is. That just gives me really good peace of mind as a business owner, with the stuff that I'm doing, knowing that I can access my money for whatever I wanted, whether it's an emergency, an opportunity, does not matter. If I just want to see a certain dollar amount in my account, I could do that too, right? So really, really powerful feature of these policies.
So it is absolutely a racket. Not to mention, that's the first level. Then the second level is they're going to take my 100 grand. They're going to lend it out to 10 other guys. Mm-hmm. They're going to say that's $1 million worth of assets on their books.
This is called fractional reserve banking, and it's absolutely insane. When you read that book, and there's another one called the Pirates of Manhattan that I absolutely recommend you read too. Is really, really good information and just history about Wall Street, tax qualified plans, mutual funds, all this stuff, that we're told is the best way to build wealth, and it's not. It's absolutely not. But let's see what. Hang on one second.
The racket. Not to mention, that's the first level. Then the second level is they're going to take.
Oh yeah, the fractional reserve banking part of it, where you put $100 in Grant's example here, you put 100,000 in, they lend out $1 million. Well, what happens if you ever get a run on the bank? I mean, this is one of the reasons why so many banks have failed for the past 100, 150 years, whatever. Because when you do that and you get a run on the bank, you have people requesting their money and you don't have deposits on hand to cover all those withdrawals. You now get the bank gets into a lot of trouble. Not to mention right now, and I just did a video on this about how the banks are in a lot of trouble right now. But plus, so you have that potential risk, but then also right now banks have massive unrealized losses on their balance sheet right now because interest rates were raised so high, so fast. Commercial real estate market's not looking good right now. Like all these problems, it leads to massive amounts of banks going under and failing. Not good. But throughout the entire history of banks failing, we'll say over the last couple hundred years, back to the Great Depression, while all these banks have failed, these mutually owned life insurance companies have never missed a dividend payment. Think about that. Like when the entire banking system is collapsing, the mutually owned life insurance companies are just chilling and paying dividends to their policyholders. Like it's just when you hear stuff like that, and when I was reading about it and doing my research, I was like, well, why am I trusting all of my money with the bank? I just assuming that the bank is the safest place to keep my money, even though it's not. When these mutually owned life insurance companies, if I purchase a policy, I'm going to get all these other benefits that a checking and savings account doesn't give me. Plus, it's with the safest companies in the world, right? And you can't have a run on a life insurance company, God forbid, barring like nuclear war, something that would cause mass casualties. Even that, though, we've got bigger problems than worrying about life insurance company going under, if that's the kind of stuff that's happening. But my point is, you don't get that run on a life insurance company like you would a bank. So that fractional reserve banking stuff, it's a non-issue when it comes to these life insurance companies. So a lot of safety, a lot of peace of mind.
My 100 grand, they're going to lend it out to 10 other guys. They're going to say that's $1 million worth of assets on their books. I think this year we had 300 bank failures in America. Okay. The books are so out of balance right now. There's $800 billion worth of debt coming due just in the apartment category. That debt's coming due this year, and JP and Goldman, all these big names have to pay. And so banks are tied to all that. Pension funds are tied to all that. And it's going to create a big opportunity. But in the meantime, it's going to create a crisis for a lot of people.
All right. So we're going to see big default.
Yeah. So I can't argue with that. I don't know where he gets 300 from. Who knows how many it could be? I mean, it could be none. Who knows? So, maybe the government comes in, bails everybody out, prints, $10 trillion. Probably going to need more than that. But I do think we're going to see a lot of stress on the banking system. I did a video on this. I'll link it down below if you want to check it out. I go into some specifics, some data, some things, just updates that I think are just creating a recipe for a disaster for a banking crisis here. So we need to be really careful with that. We need to be aware of it. It's why I've moved a lot of my money out of the banking system, out of the bank into these dividend-paying whole life insurance policies. Again, it's not financial advice. I'm not telling you to do that. I'm just sharing what I'm doing right now. And of course, I still have some money in the banks to cover expenses, just basic expenses. But do I want my working capital, my opportunity money, my emergency money, the large amounts of safe money that I've allocated for these things? Do I want it sitting in a financial institution that has a terrible reputation for bank failures, tons of bank failures? They have the fractional reserve banking system. There's massive unrealized losses on the balance sheet right now. We've got the commercial real estate market, that can potentially cause a lot of problems for the banks too. And not to mention just the history of banks. Like, do I want my hard-earned money in that type of financial institution? Not really. And not to mention, it's not really doing anything for me when it's in those accounts anyways. So let's continue.
Like 08, but not from the consumers, but from the institutions.
Institutions, and that's going to require.
Real quick, the other thing I wanted to mention too is that these policies are fantastic opportunity funds because we can store our large amounts of opportunity capital in these policies, and when you set them up correctly, you can get access to 95% of that cash value within the first 30 days. So if you're sitting on the sideline waiting for opportunity, and it's just sitting in a money market account or a checking account, whatever, again, this just makes sense for me. I'd rather have that money sitting in a safer institution, number one, but two, getting all of these other benefits that these other accounts don't give me, like that massive death benefit, living benefits, the 3 to 5% tax-free compound growth, the peace of mind, just being able to sleep a little better at night, not stressing or worrying about money or like where my money's at. Like, it just makes sense to put it there because I can access the majority of it anyways for when opportunities present itself. And like Grant said, I think there's going to be some good opportunities that come along in the near future here.
Require more printing of money. The U.S. is like $34 trillion in debt. I think I saw something earlier this morning where we literally need another $1 trillion. What was the number? Was it $1 trillion? Yeah, another $1 trillion every 100 days.
Okay.
Crazy.
So every 100 days, 3 times a year, 34 trillion will become 37 trillion. 37 becomes 40 trillion. 40. What's going to happen here? You got to keep printing money. So where do I want to be? I want to be in real assets. I want to be in Bitcoin. Absolutely. I'd want to be gold and silver. Not so much for me because it doesn't do anything.
Right.
Like I don't get it. Right. You can always get more gold. There's more gold. They've been finding gold for my whole lifetime. So.
Yeah, couldn't agree more. I think holding assets, I mean, I'm a huge fan of Bitcoin. I love things like flipping heavy equipment, private money lending. I have some silver as well, but having assets to that are going to keep up with or outpace inflation is really, really important, because if you just have your money in an account that's not doing anything, well, you're losing purchasing power literally every single day. And, unless you've been living under a rock right now, things are incredibly expensive. It's unbelievable how much purchasing power we have lost just in the last couple of years. It's absolutely ridiculous. So we want to insulate ourselves from that. And I guess in a way, just profit from it too, because we're not going to change the system. Nothing's going to change here. The only thing we can do is because all that stuff is outside of our control. What we can control, though, is what we do in our own lives, where we position our money, where we put our money to have it perform multiple jobs, as many jobs as possible, give us as many benefits as possible, keep up with that inflation, outpace it if possible. And at the end of the day, I mean, that's really all we can do. So educating yourself, I think, is really important too. Creating cash flow, buying those cash flow assets or creating multiple streams of income, I think, is really important. Just to hedge against this stuff, And
nobody's ever traded with me. In real estate, the people got to have push slip.
Right. Do you think the public is waking up to the fact that they need real assets? I mean, for the first time in maybe years, people talk more about money printing, talk about inflation. Do you think people get it, or your average?
Yeah, I think people are angry about it, but I don't think they really get it.
They don't understand.
I think they're like, they don't want to confront the scam, so they just keep saving money at the bank. The best somebody's going to do is, I'm saving my money. You're not saving your money. Your money's going down in value. Not to mention the depreciate every time they print. By the way, I don't mind if they print. I get excited
when they print money.
I love it.
Okay.
Because I know I'm
Yeah.
gonna get more.
Right. Because people have more money.
You got more money, bro. I'm gonna get more money.
Right.
Yeah. So, you know, I see where he's coming from with this. Like, if you own assets in an inflationary monetary system or a monetary system built on inflation, then you like inflation because your assets go up in value. From a philosophical and principle standpoint, though, I can't stand it. It's absolutely disgusting. It's literally theft. The way that like how much money they print and how, you know, how it extracts so much wealth from people. It's just disgusting to me. So I'd rather not have it than have it. But I see his point where, you know, if it's not something we can control, and this is the system we have to operate in, then we need to do the best we can to take the most advantage of it, protect ourselves, take advantage of it, build wealth with it, you know, just utilize it to our advantage. And part of that is having assets that outperform whatever inflation is, or at least keep up with inflation, do well during inflation, things like that.
So print it because a hustler doesn't mind. Like if you know how to go get money, you actually want more money in the system. The other side of that is if you own assets, you want printing. Okay, wealthy people want the print because the print means the assets they own go up in value.
Right. The people that don't want the print are the lower classes and people with savings.
Yeah, because your groceries are going up, your rent's going up, your electricity is going up. If you're a saver, you don't want inflation.
Okay.
If you're an investor, you want it.
Talking about this upcoming crisis, because 08 was hard on you, and you're always really honest about how hard it was. And the conclusion you made, I think with Elena, was we were going to get so big where that's never going to happen to me again. And it feels like you've been doing that the last, 16 years, trying to get so big.
Yeah.
Have you done what you wanted to do? And, and are you ready for this next one?
I am definitely ready for this.
Because you're wiser.
Yeah, I'm wiser and I'm more courageous.
So let's touch on this really quick. So he's talking about where he wanted his business to be so big that he would not go through what he went through during the 2008 financial crisis. And the way that I would translate this for my life, the aha moment that I had is creating a really solid financial foundation. That's essentially what we're talking about here, where you become as bulletproof as possible, regardless of, like, you're set up in a way that no matter what happens, you're good. You know, maybe you take a hit over here, but over here something does really well, and you have a lot more control of the impact that this chaos and uncertainty will have in your life. And when I heard that, I just immediately thought about my dividend-paying whole life insurance policies and utilizing the infinite banking concept. Like, I'm not worried so much about what is going to happen, because I know that I have my money with the safest and best risk management companies in the world. It's going to get that 3 to 5% tax-free compound growth. I can use it to scoop up opportunities, you know, if we do get a major recession or whatnot. And it makes you feel a lot more secure and insulated from all of the things that are going to go wrong. You almost get a little bit excited. It's sad because I always hate to see people get hurt and go through hardship. But these are just I want to call it a natural cycle of boom and bust for markets, but it's not natural. These are bubbles and cycles created and manipulated by the Federal Reserve, by the government. But my point is that these things happen. We have markets go up, markets crash, markets go up, markets crash. Okay. And it's where we have the real opportunities to build wealth is during those downturns in the market cycle. And we're able to get these assets, a lot of, hopefully income producing assets at much cheaper prices. But you have to have that really solid financial foundation in place first, in my opinion. Like I used to be super broke. As I started to come out of that, I wasn't thinking about doing any investing whatsoever. My goal was to build a solid financial foundation so I never have to go back to where I was ever. Like once you've been super broke, you never want to go back. Okay. And I think that's kind of the philosophy of what he's talking about here, is creating a really strong financial foundation for yourself so that no matter what happens, you are ready for it. And you're ready, not just to survive whatever happens, but to thrive as well and take advantage of it as much as you can. For me, there's no stronger financial foundation than setting up a dividend-paying whole life insurance policy with a mutually owned life insurance company, and potentially implementing the infinite banking concept, because of how strong these companies are, because of all the benefits we get from just this one financial vehicle. It's awesome.
And I'm more confident in my strategy, right? Okay. And I just didn't have that then. I didn't have complete confidence. And that confidence just comes from doing deals over and over, making mistakes and recovering from the mistake. Like, making a mistake is not really where people, I hear people say, hey, I learn most from my mistakes. I learn nothing from success. I learn a lot from success. Like, when I'm successful, I learn a lot. I'm like, dang, do that shit again. Like, go hard on that again. Do that exact thing right again. It's not a lucky, it's not like wear that same underwear. Like, do whatever you said, repeat it. That activity worked, right? So I do learn something from success. And on the failure side, I don't really learn from failure like, oh, wow, I screwed up. But I do learn because I picked myself up and the failure didn't kill me. And that creates this, oh, wow. You know, it'd be like getting in a fight, getting beat up. If that's never happened to you, you're really worried about it. But once you get beat up once, you know, you ever been beat up?
Yeah. So this is more like principles of success and, you know, the journey to getting to success. And I would agree with a good majority of that, where, I mean, I learned from both success and failure, but I think the biggest lesson for me, when I was going through my financial disaster for a long time, coming out of that, the biggest lesson I got is that I can find my way out of this, right? I can do what I need to do to fix my situation and continue to grow. Like, it does build a lot of confidence in yourself, because if I can maneuver my way out of that position, put the work in, get the results, and get myself out of that situation, what else can I do, right? It just gives you this sense of pride and confidence and it's really good for your self-esteem. And it just makes you more confident in general, which is going to build, like, success builds on success. So that confidence is going to allow you to build even more success. It's because you show up more powerfully in your business or your job or whatever it is that you're trying to do. So when you get out of those situations and you recover from them, it's really, really good for your confidence. And that's going to help you build even more success. That's just been my experience.
Yeah. As a young kid.
Yeah, I've been beat up.
In martial arts training, I got beat up a lot.
Well, there you go. So you know, it's like, okay, once I know what a hit feels like, I'm not as scared of it. Yeah. It's because I know it's not going to kill me.
Okay. So you're going big now.
So 2008, yeah, it was like, okay, I just got played with, and a bank failed. A new bigger guy came in. They started pushing me around because I owed them money, and they started shoving me. And I'm like, and I had money to pay the bills. I was never late. The loan was technically a good loan, and they just started pushing and shoving on me. And I'm like, I'm never going to be in this position again.
That was another major aha moment for me when I was thinking about it. And I just immediately thought of my policy and the policy loans that we're able to take against our cash value. And here's the thing is, when you take a policy loan, it can't be called, like, because the reason is because the life insurance company knows that they are going to get paid back that policy loan via the death benefit. So when you pass away, if you have an outstanding loan balance, it gets deducted from the death benefit. And then when you pass away, and then whatever's left over, that's what gets passed on to your beneficiaries, income tax free. So the life insurance company is not worried about a policy loan whatsoever. And because they know they're going to get that back once you pass away. So we don't have to worry about, like, when economic conditions change and banks fail and all this stuff. You know, if you have outstanding loans right now, we don't need to worry about those getting called by the life insurance company. And there's just so much peace of mind involved with that. Now, I'm not saying to never use banks for financing, but I'm saying if you are completely reliant on the banks for your business, it might be something you want to take a second look at and really evaluate the amount of exposure you have to the banking system. Is this a potential issue, right? And if it is, it might be a good idea to at least consider diversifying where you get your financing from. And that is the whole concept of infinite banking, is starting your own privatized banking system, so we don't have to rely on the banks for everything. Again, not saying to never use banks, But what he's talking about right now is he had a really good loan. He had money to make payments. He was making those payments, and that loan was good. Yet they still called that loan and forced him to make to pay off the loan balance. And the last, I don't think he gives the exact amount, but it was like tens of millions of dollars. And that's a pretty stressful situation to be in, and really frustrating too, considering that he was able to make the payments and keep the loan good. But they have the ability to do that. And with these policy loans, we don't have to worry about that because, again, it's collateralized by the death benefit. Now, one thing I do want to mention, though, is with policy loans, you do want to make sure you're paying your loans back. Maybe not necessarily during retirement if you're creating income from the policy, but you want to make sure you're working with an agent that has experience with this stuff, because you don't want to over leverage the policy, because that can cause the policy to lapse. If your policy loan balance gets too large and you don't have enough cash value to cover the interest payments on that policy loan, you could put your policy at risk of lapsing. It's not very common. You have to be really, really irresponsible with a whole life policy for that to happen. But I do want to disclose that because that would be like the one major risk that you want to be careful with. But again, as long as you're a good steward of your money and your policy, you're utilizing it correctly, you're paying those loans back, then it's not really an issue. But the point is, this offers more control within our business and what we're using our policy to invest in. I don't have to worry about the life insurance company calling me up and say, hey, you need to pay that loan back. There's a lot of peace of mind involved with that.
And the way to not be in that position is to own so many assets. I know this is very difficult and kind of out of reach for a lot of people to listen to, like, how are you going to get there? Well, the same way I wasn't there 16 years ago, which seemed like yesterday.
Okay.
So
acquire assets. That's what they need to do.
You have to acquire. Don't buy stuff. Don't buy stuff. Okay. Buy assets and own real buildings that you can control, or a real business. The buildings are better because the business is going to die.
Okay. Right. But the buildings won't. Is it true you make yourself broke now every single year or every single quarter?
Yeah, I do.
You take any extra cash you got and you put it into things you can't touch.
Yep.
And then you got to start again.
I'm into illiquidity.
You love it because it pushes
I love
you.
being illiquid because the banks tell you to be liquid. Wall Street says be liquid. But when you're liquid, you're a target, right? So if I go to Starbucks this morning, I don't have any money in my pocket. So if we go to Starbucks, you and I go over there, guess what? I can't pay because I'm not liquid,
right?
So I got to lean on my guy, Brian, and say, Brian, you mind picking this one up? I never have any money. So I don't want cash.
So what I get from this is that he always wants to make sure that his money is working for him. It's invested in his real estate business or whatever else that he's working on. I do think it's important to be liquid to take advantage of those opportunities. There's going to be some points in time where your money's not at work, right? Like I just closed on our first heavy equipment deal. That sold. So now I have that money coming back into, I'm going to be putting that money back into my policy. So I'm going to have that liquidity for a certain period of time, but it's only until the next opportunity presents itself. So there is a lot of value in having liquidity, both for emergencies and opportunities. But I see his point where we do want to, when we can, have our money working for us, because we've got inflation, other things to consider as well. But always having our money at work if we can. The good thing about these infinite banking, dividend-paying whole life insurance policies is that they're getting that tax-free, that 3 to 5% tax-free compound growth, regardless of whether or not we're using the money or the cash value to build wealth, right? So again, that's another major benefit of these policies. So, and I think he's gonna bring up like the 6-month savings issue or whatnot. I actually think that is a good thing. But again, making sure that if we're going to have an emergency fund, an opportunity fund, why not have it in the most efficient vehicle possible, as opposed to just having it sitting in a checking or savings account? It's just my opinion. So let's continue.
Cash in the bank. I don't want money in an account over here. I don't even want 90 days of savings for the emergency account. That's so recommended by all the financial gurus and consultants and whatever they call themselves.
Because you'll end up spending that on something you shouldn't.
Bro, look, you're literally pulling the law of attraction into you by having 90 days of savings.
Okay.
You're literally saying,
I'm going to fail.
I need an emergency.
Okay.
Yeah. So this is where I disagree. For me, like knowing that I can cover just about any emergency that comes up, that helps me sleep really good at night. I don't think it also frees up it gets rid of the stress. It frees up the mental capacity used, the mental energy used when you are stressing about like, oh, what if something happens right now? Or if something does happen and you can't afford it, it's because you didn't have the emergency fund. Like, those are things that I think are really, really important. And having an emergency fund helps solve those problems. Brian was talking about how if you have that money, you'll spend it. Well, that's something you need to work on internally to make sure that you're not spending all your money whenever you have it. You need to be there. There's a certain level of discipline you need to have with your money. That's just my opinion. Just because I have money that I can spend, it doesn't mean I'm spending it. Like, that's on you. Okay. But the law of attraction thing, like if you have money over here, you're basically saying I need an emergency. I don't agree with that. I don't think that should sway anybody to not have an emergency fund. So that's where I would have a little bit of pushback. And especially since my emergency money is not just sitting in an account doing nothing. It is in a dividend-paying whole life insurance policy, earning that 3 to 5% tax-free compound growth, waiting for an opportunity to present itself. Or if an emergency comes up, I have it.
Okay. Well said, man.
I have to have an emergency. I have it funded. I'm ready to go. Somebody's going to steal the money from you. It's definitely going to depreciate. Hopefully you never have an emergency. So then it was just a waste and it should have been invested.
Quotes I always get from you is money is useless until it's being used.
That's right.
And you always,
when it's in a dividend-paying whole life insurance policy, it's growing. So, and plus all the other benefits you get. It's not just sitting there doing nothing.
Say, would you rather have $1 billion or 1 billion friends?
Yeah.
Both of those to me relate to this concept of cash flow that you've pushed, as in, is it cash or is it cash flow? This is the story of you, I think. And yet we're all brought up to value cash.
Yeah.
Even in the rap videos, it's like, look at my $100 bills.
All right. So I'm actually, we're hitting like the 45-minute mark here. So I'll probably break this up into 2 parts. I'm going to go ahead and wrap up here. I hope that was helpful, guys. I don't know about you, but I just had a ton of really good I got a ton of really good lessons and just really good aha moments just from the first half of the video here. But I definitely encourage you to watch the full video. I'll link it down below. And then I'll link part 2. If I do decide to go through the rest of it and do a part 2, I'll link that down below as well. But yeah, drop some comments down below. Any questions that you have, any feedback, I'd love to hear your thoughts. If you want to have a conversation about potentially setting up a policy for yourself, if it makes sense or not, we'll go through your goals. We'll talk about your current situation, what you're looking to accomplish, and we'll see if it makes sense for you. It's definitely not for everybody, but it does provide a really, really strong financial foundation for you to put your money in the most efficient vehicle possible and get all the benefits from that one vehicle. So I hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty Ice is out.